You know those spots where prices keep tapping on a level with long wicks, but they never really break through it? That is usually not random. That is liquidity. It's the market showing you where buyers or sellers are stepping in and defending a zone. The problem is most traders see the reaction, but they do not know how strong it really is. That is where the Liquidity Clusters Magnitude by LuxAlgo comes into play. This tool measures how intense those support and resistance reactions are by counting wick touches at key liquidity levels inside a rolling window. So instead of guessing whether a level is really important or not, you get a cleaner, more data-driven read on where reaction and rejection is actually building. Now, we're gonna build this on TradingView, which is the platform I'm gonna be using for this video. If you haven't signed up yet, there's gonna be a link in the video description for you to do that. Next, you wanna open any trading security that you like in any time frame. For me, I'm gonna be using the 15-minute time frame of GBP/JPY. Just remember, this strategy works on any trading security and on any time frame. Next, you wanna open the indicator search tab and type in Liquidity Clusters Magnitude, and you wanna select this one by LuxAlgo. After adding it to your chart, you'll notice that this is not a normal support and resistance tool. It's an oscillator-based system that turns wick rejections into a readable structure with smoothing, a trend bias metric, and a real-time dashboard. Now, once the indicator loads, the first thing you want to understand is the core idea. This indicator is not tracking every little move in price. It's focused on wick-based rejection. In other words, it looks for places where price reached a level but did not accepted there by the close. This matters because wicks often show where strong buyers or sellers actually stepped in. Now, to make those levels more reliable, the script uses a body crossing constraint, which means the liquidity levels stay outside the highest and lowest candle bodies in the window. That way, it is not just drawing random lines. It is isolating levels where price was tested but not sustained. Now, let's take a look at the components. This indicator plots three main metrics on a centered oscillator. The first one is Bullish Magnitude, shown in green. This measures how often lower wicks are tapping into a support liquidity cluster. When that green reading gets stronger, it means buyers are absorbing selling pressure at that level. The second one is Bearish Magnitude, shown in red. This tracks how often the upper wicks are rejecting from a resistance cluster. Stronger negative readings there tell you that sellers are defending overhead supply. Then you have the trend metric, shown in blue. This is a composite line built from the difference between bullish and bearish magnitudes, and it gives you the market's net liquidity bias. If the blue line leans upward, supply rejection is stronger. If it leans lower, resistance rejection is stronger. Now, the visual design makes it even easier to read. The oscillator has vertical gradient fills that work like a heat map. The stronger the liquidity cluster, the more intense the color gets. As the reading fades towards zero, the color fades too. That means you can glance at the pane and instantly see where real rejection density is building. On top of that, when either bullish or bearish magnitude spikes above the threshold you set, the script prints signal dots. Those dots mark significant liquidity events. They can signal absorption, exhaustion, or a strong defense of a level. There is also a real-time dashboard that shows the current magnitude readings and the overall trend state, so you're not stuck trying to read everything candle by candle. This is what makes this indicator useful. Traditional support and resistance tools usually show static levels. This one is different because it measures how often price actually reacts at those zones. It's not asking, did price visit this level? It is asking, how many times did price get rejected here and how strong is that rejection right now? This gives you a much clearer read on hidden supply and demand, order absorption, and whether liquidity is expanding or thinning out. Now, before we get into trading, let's go through the settings. The first one is window size. This controls how far back the script looks when it is identifying liquidity clusters. A larger window will focus on bigger, more established levels. A smaller window will react to more local, short-term liquidity clusters. If you are day trading, you may want a smaller window so the indicator reacts faster to recent price action. If you're swing trading, a larger window can help you focus on more important historical zones. Next is smoothing. This changes how responsive the magnitude lines are. Lower smoothing reacts faster, but it can be noisier. Higher smoothing slows things down, but it gives you cleaner signals. Then you have magnitude threshold, which decides what counts as a significant liquidity event and when the signal dots should appear. Raise it if you want stronger spikes, lower it if you want more frequent alerts. You also have visual settings for colors, gradient intensity, and signal dot visibility, plus dashboard controls to show or hide the dashboard and adjust its size and position. Now, let's talk about how you can use this indicator to trade. The most direct use is reversal trading. For a long position, I want to see the price trading into a support area while the bullish magnitude starts to spike. That tells me lower wicks are repeatedly defending the same liquidity cluster. If that spike is strong enough to clear the threshold and give me a signal dot, that is even better. Then I look at the trend metric. If the blue line is rising or already positive, that tells me support rejection is dominating resistance rejection. That is the kind of setup where I want to start watching for a bullish candle confirmation, like an engulfing candle, a strong reclaim of the level, or a rejection wick followed by a close back up. This is where I would take a long position, put my stop loss below the support, and aim for the next mean area or the next resistance. The indicator's own strategy notes say extreme bullish magnitude spikes near range lows can be used for long entries, and that is the cleanest way to think about it. Now, for a short setup, you want to do the opposite. Price is moving into resistance and the bearish magnitude starts building. That means upper wicks keep rejecting from the same resistance liquidity cluster. If the bearish reading spikes above the threshold and prints a dot, that is your warning that supply is active. Then look at the trend metric. If the blue line is weakening or leaning negative, that tells you resistance rejection is overpowering support rejection. At that point, you want a clean bearish trigger on price, like a bearish engulfing candle or a failed push above resistance or a strong close back under the level. That is where a short position makes sense. Put the stop loss above the resistance level with the first target aimed toward the next support or toward the mean of the move. Let the trade run, and as you can see, it was profitable. There is another smart use for this tool, that is trend confirmation. If the price is already trending up and you notice that bullish magnitude keeps dominating bearish magnitude, that is a sign that demand is still being defended. In that case, I am less interested in fading the move and more interested in buying pullbacks. The trend metric helps with that as well because it doesn't just show price direction, it shows where rejection pressure is accumulating. A positive bias means more support rejection than resistance rejection. A negative bias means the opposite. This can help you stay aligned with the stronger side of the market instead of trying to catch tops and bottoms too early. One important note though, this works best when you combine it with the market structure, volume, or breakout confirmation. LuxAlgo's own FAQ says it can work on its own, but it performs best when paired with other context tools. That means you still want to know your higher time frame support and resistance, your trend, and the general market environment. This tool improves your decision making, but it should not replace judgment. Instead, it should sharpen it. Note, this is not financial advice. Use this for education only. Test it on your market, build rules around your entries and exits, and size your trades based on your own risk. If you found value in this video, please leave a like, and if you want more breakdowns like this, consider subscribing so you don't miss the next one. Thanks for watching. See you next time.